Greetings, everybody. It's Jeff Scott, and I am doing this in Prague in the Czech Republic. I've just had a great 21-day trip with my bride of 34 years. Excuse me, 33 years. Of course, she's here correcting me. If she corrects me on my stock analysis, I'm in trouble. Had a great time. We've been to Venice, Dubrovnik, Mykonos, Santorini, Athens, Olympia, and then Budapest, Prague, and Vienna, and I am ready to come home, and we're on a plane tomorrow morning. Also spent the first half of the trip, which was a cruise, with John Person and a bunch of his students, which was a lot of fun as well. I entitled today, Risk is Rising, but is it a time to sell or a time to buy? And you might be surprised at what I think. Not that I necessarily know exactly what's going to happen. I'll just tell you where I'm putting my money. As always, for education purposes only, any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. I paid for every tool that I use, and trading involves risk. You and you are solely responsible. If I talk about options from time to time, keep in mind that the options industry council would like me to warn you that options are very risky, and if you use options, you use them at your own risk. And the Option Industry Council, OIC.com, has some great tools and education for you. Just as an aside, since I'm using my travel computer, the sound will probably suck, but hey, at least you're getting a video. As always, I always like to thank the people whose education I've learned from that helped me develop my own style. When I do my education programs, I try to teach you to become your own guru. I learned from Ian Woodward. He learned a lot from William O'Neill with the basis of CanSlim, Morales and Catcher, who were money managers from O'Neill, who took it to another level, pocket pivots, Bible gap ups. Ron Brown, who's kept going in the with Ian's Woodward and Brown entity and has developed his own trading style using volume spread analysis. Here's John, author, developer of great indicators, some of which are free on Thinkorswim, become a friend of mine. And I use a lot of his tools. Van Tharp, the king of money management. George Lee, my favorite person from Vancouver area, great trader. We've shared the podium several times. And a lot of you have recently met SN or heard SN, Sanger Natty, on our board. And his tools from Superior Profit I find to be complementary and help me improve my trading. I do not consider his program a replacement for HGSI. It's a different set of tools, and I still use HGSI as my core program. What do I need on a desert isle? I need my trade station and Thinkorswim with some of my indicators. Genesis is great for futures, but for most of you, I know that's not a big issue. HGSI is where I do my analysis. EdgeRater supplements that, and then I do follow seasonality, and there's a number of websites that I use. Back to highgrowthstock.com, HGSI. As I said, I have no financial affiliation. I get nothing if you subscribe, but I do think it's worth it. There's a free 30-day trial that does not require a credit card, and if you go under investing strategies, you'll see lots and lots of material from me, Ron Brown, and others. And if you do sign up and you're confused by the toolbar, what do I do next? Drop me an email at hgsi.com, and I'll send you a set of videos that I prepared to help people. They're getting out of date. There's newer ones on the board, but some people have found them to be of value. As always, I always like to wonder where we are in the market, where I am in an industry group, stock, etc. And it's fractal. It could be at any time frame I'm looking at. And it's really easy, I think, to know when the market's been beaten up and gone sideways for a while. You get a eureka, bunch of kahunas on the indices, and you get in the time to buy and the time of greed. To me, a buy signal is often an event that occurs. Futures open up down 400 and close positive on the day after a downtrend, where a sell signal is more of a process. And we've been in a topping process for quite some time, and maybe we're there. Unfortunately, it's been a tough market for many people this year and last year as well, as we've sort of truncated the top of this curve. And every time it looks like we're going to sell, we go back up with another leg higher. It's funny, as I do my top and bottom down analysis for the weekend, sometimes when everything looks great and it's time to buy everything is when the market actually has a horrible week. And this week was more the opposite, where There's a lot of ugly looking charts. And sometimes when it's hard to find great charts, it's when the market stages a rally. So, but more to follow on that as we go. How I trade the markets varies with the cycle of where I think we are. I clearly am living in that uncertainty stage. I am long more than short. I have positions to both sides. I have raised cash and I have smaller positions than I've had in the past. And I am selling some premium, which will buffet any downtrend. I always start by looking from a sector perspective. And here is a list of sectors and some of the key stocks. I've got to update some of them every time there is a transaction, something no longer trades. And I got this from John Person with a bunch of indicators, which I stripped off. But I can step back and what can I see? I can see that materials were strong on Friday. I saw that in my top-down and bottoms-up review with a lot of specialty chemicals, steel, and even some of the shiny metals looking interesting. Energy, OPEC had a lower than expected raise in the output, and energy stocks were extremely strong. You can see mostly a sea of red there. Financials, especially regional banks, very weak. Insurers were mixed. Brokerages were weak. Going down the list, credit cards looked okay. Then I have industrials, which despite a tough week, looked okay on Friday. Technology overall looks okay, but semiconductors, especially when I think about something like Micron, which had great earnings and still traded off, despite multiple brokerage upgrades. Stable, strong, discretionary weak. Retail weakening. Utilities super strong, as was XLLV and DRG Healthcare. Biotech up on the week, but was mixed on Friday, as were transports, almost all the airlines trading down, probably in trucks because oil went up. As I said, shiny metals were strong on Friday. Here's miners, home builders weak, REITs were strong on the week, casinos mixed, and social media mixed. So I look at this intraday, I look at it end of day, and it gives me a clue as to where the money is flowing. Obviously, I can get similar answers out of HGSI, but for me, it's a quick glance to get an idea during the day. Now let's just go into Thinkorswim here and take a look at the major market indexes. This is on, make sure they're daily. And as much as I want to be bearish right now because of last week and the sentiment in the market, I'm not sure I can be bearish. Here is the E-minis, certainly in an uptrend. In a short-term person sell signal, it would not shock me to see us come down here and touch the 50, which we did in the past. But am I a buyer or seller here? I feel this market is potentially going higher, more so than it's going down right away. And frankly, I could play trend line games, and I do that sometimes, usually at HGSI. And I could kind of look at this, and that's not exactly what I was trying to do. Try this again, drawing tools. Let me touch it here. Let me touch it up here. Whoopsie daisy. I mean, you could even argue that we have pulled back to a rising trend line. So I'm not sure I'm willing to give up the farm here. This is the E-minis. I think that they are clearly weakened, but I'm not convinced that they're done going up. Let's look at the NASDAQ futures. Obviously, a very tough day on Thursday and Friday after setting new all-time highs on Thursday. It's hard to be a perma bear when we set all-time highs one trading day ago. If I look at the Dow's been weaker, no question about it. Had a positive day, probably led by energy and material stocks and some strengthening of the industrials. And the Dow has suffered the most from the trade war. This one looks weak or sideways. And then the Russell also set a new high. This one would be on Wednesday and traded off, but still sitting above its 17-day moving average. Now, one might have expected the dips to spike last week with Thursday and Friday. hard for me to call this a spike. It's still in chop range, and it held twice, Thursday and Friday, at the falling 50-day moving average in yellow. And lastly, the dollar had a sell signal came in. Now let's go to the weekly charts very quickly. So this takes the switch. That wasn't too bad. Because if I look at these, and what I wanted to point out is look at the E-mini clearly in an uptrend, the NASDAQ clearly in an uptrend. Yeah, the YM, the Dow futures going sideways here, but longer term in an uptrend. The IWM, yeah, they had a lousy week, but weekly new highs, clearly in an uptrend. The VIX still struggling to get above this weekly 200, and the dollar breaking below the 200. There are some people like Kudlow, and I think Larry Summers as well, that love a strong dollar. And I think long term, especially as I'm traveling in Europe, a strong dollar would make my purchases cheaper. But at the same time, a strong dollar also hurts the metals, and it hurts some of our multinational companies. So a weakening or easing of the dollar to me is not necessarily a bad thing. All right, turn this back to where it's supposed to be on the dailies. Let's shut down and go back here. And then I look at the same three time frames, daily, weekly, and now monthly. E-minis, NASDAQ futures, Russell futures, NYSE, and Dow futures. And, which one is not like the others? Well, clearly the NYSE and the Dow futures have sold off much more than the others. You look at the monthly, especially E-minis, NASDAQ, and Russell, and you see a lot of continued upside momentum. Now, a couple of things underlying the market that I look at. Rates are stabilizing. They actually pull back on both the 10-year and the 30. Pretty much very minimal change week over week. Now, as I did my top-down review, I saw strength in REITs. Not a lot of strength in banks or regional, especially regional banks. So rates right now, despite the fact the Fed's going to tighten more, maybe it's the trade war fears that are making people discount that. Rates are stable, and they're both below rates that I think cause pain in the market. And certainly rates, as I said, are stable. AD lines, this is a reason to be bullish, in my opinion. Here's the Russell 2000. You could see the AD line to new highs, even though it's a slight pullback in the stock. Large stocks, Russell 1000, the same picture. Now, I look for a divergence with AD lines falling off before the stock price, and that would worry me. The fact that the AD lines are staying high, to me is a positive finding. In fact, in white is the AD line here of the NYSE. These here are the ETFs of the major markets, and you can see all of them have given back a little bit, while bonds down here, the TLT, have improved. But that is a very strong looking AD line. And if you go back to that correction in 2015, which was probably the last big correction that we saw, looking at something like, just looking right here, you can see that this AD line sold off, and actually it sold off before many of the stock markets rolled over. So that to me is on the bullish camp. Breadth, stocks above the 200-day SMA, stocks above the 40 both drop. Yet when I look at my 3-month new high, new low index, which these are in TC 2000, probably could create them in HGSI, but they're so easy to do it in TC 2000. We're higher. Now, this thing is like clockwork when we get up near the top or near the bottom. We're not there yet. And when I say it's like clockwork, every time we've hit these lines, overbought and oversold, I've seen the market reverse. We have more room to go higher here. The daily McClellan, I look for divergences, and with the sell-off here in the daily and the weekly, I don't see any divergences. It'll be interesting to see where this market goes, but I don't see a signal from the McClellan. I look at buckets, 57% of stocks in the S&P 1500. As of Friday, we're trading above the midline of their Bollinger Bands. That's slightly bullish. I look at overbought stocks above their Bollinger Bands, oversold below, and I don't see a pattern here except to say it's more bullish than bearish, certainly not overbought or oversold. HINDYs, well, on the NASDAQ, we do have a HINDY free zone, but I got to take out the word free here because as was pointed out by Robert Minkowski, I commented on it as well. We did have Hindenburg Omen fire on, I've got 2 in EdgeRater, 3 in HGSI that fired last week. Now, there are calculations. There's a what you use as your index matters. There's some commentary about that. I look at both of these and I see a signal on Thursday and on Monday. So when you start to see a series of Hindenburgs firing, it has to stiffen your neck. And those that know about the Hindenburg Omen know that there has not been a major correction in decades that was not preceded by these indicators firing. However, those who have been around the block know that 1 out of 4 of these are significant. The majority of them are very small and no pullbacks at all. When you start to see multiple ones firing at the same time, you want to pay attention. So let me stop it for a second. I want to pull up and show you what I'm talking about. All right, I'm back. So this is from Ian. Whenever you see a white slide in any of my presentations, these are slides that I received from Ian or given permission to use. And so he introduced us to the Hindenburg Omen a decade ago. Strong warning signal for a market top, and it signifies the herd, meaning the amateurs like us are buying while the pros are selling. Here is the definition. I'm not going to spend much time. We try and reproduce as close to this in EdgeRater and HGSI to get the signals. You look for a second one within 36 days. We had that, so it's a confirmed signal. These are some of the drawdowns that Ian measured before the big one. 6 out of 23 times when we saw a Hindenburg Omen, there was a 25% or more correction. Here's how I use it. This is 2006, where you see paint bars, like significant number of Hindys fired. Notice the market kept going up and then the market died. So the first one, should have been better here selling there than down here, but you still had the market going up. A single one by itself was meaningless. And then as we went into 2007, we started seeing them. This is July and August with multiple firing, and that led to a 14% drop. But then the market had a reversal here. This is that reversal signal that even my wife could pick out. And then you had a big market run up, and then you saw the big ones with the black swan, and the rest is history. So you want to avoid those major sell-offs. We haven't seen a lot of Hindenburg Omens in a long time, so I pay attention. You should as well. Doesn't mean it's over, but it means risk is rising. Market tone. I focus on the bandwidth, the Woody indicator. Green is a buy, yellow is neutral, red is a sell. And you look down on Friday, everything's green and yellow. That can't be very bearish, can it? So the market tone is not as bad as I thought it might have been. Sector strength, you can look down here and you could see that discretionary and staples were green, as is utilities. And you have some red here. It looks like that might be industrials, and financials were leading the market to the downside. Another thing that I do is I've created some artificial indices. This is something that was taught to us by Ian. In fact, he gave us the Canaries price line is now bookings. And I see on the Canaries a 2-day pullback or off of all-time highs, stopping at the 8-day exponential moving average. I'd be buying here, not selling based upon this chart. This to me is a soft little flag in an uptrend and doesn't mean this is over. That weekly bongo is green. That's meaningful to me. And you notice the Hindenburgs fired up here. I put together a newer list in January which did identify a top, which occurred right after I put the list together, which is why you put the list together. And I just keep tracking the stock of past leaders, and it too is sitting on the 17-day. More bullish to me than bearish, to be honest. Doesn't mean it's not going to get a whole lot worse. Know your news and earnings, new home sales on Monday. Fed heads speaking on Tuesday with some consumer confidence numbers, Case-Shiller, S&P. You look on Wednesday, crude inventories might be important. On Thursday, you got some GDP, third estimate. You got initial claims, bank stress tests coming out, more Fed talk. And then on Friday, you can see here a number of things. I guess the scary thing here is measures to restrict Chinese investment in the U.S. by June 30th needs to come out. That could be scary. Looking at earnings, and boy, I didn't do this. I just copied it, but somebody spelled it wrong on the internet. But you could see, even though there's not a ton of earnings this week, you've got a number of things that you may own, and that if you own them, it's a big week. Nike, Constellation Brands, KBH. And this is my statement here. Others may have said the same thing or implied it. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So what are my thoughts? Trade war fears led to a broad-based sell-off last week. Supreme Court tax decision weighed on e-commerce. Changes in the CEO at Intel raised some technology concerns. OPEC, which was bullish for energy stocks, had a less than expected increase. Seasonality, I'll show you something that I thought was kind of remarkable. It's strong right now, leading perhaps into a 4th of July rally. Last week was tough on growth investors. Considering seasonality and strength in AD lines, I'm a buyer here. The presence of the Hindenburg signals is concerning and will temper my enthusiasm, and I'll keep a short leash on any new positions. Now, let me just stress that I'm not stupid, and I'm not putting out naked buys without watching. I'm going to watch the futures tonight. Trump could put something out that says, I'm doing this to China. China can use the weekend to say we're adding more tariffs on the U.S. The EU may add more tariffs to the U.S., and the market could be totally different in 2 hours than it is right now. And unfortunately, news and tweets are likely going to rule the day. So let's go through my typical top-down approach. Close that down. Now I want to show you a couple things here. This is last week's performance. Now, I don't always make money in the markets. Nobody does. And that last week was a tough week. So I looked at a number of different groups that I watch. And I looked at from Saturday the 16th to Saturday the 23rd. And the first thing you notice, you can't count these things with zeros. I guess I didn't break out into the subgroups like I usually do. So the ones above that were wins, and the one below that were losses. And these are groups that I follow. The S&P 500 was down 0.68% from Friday to Friday. My holdings were down 0.27%, so I'll take that as an outperformance, even though it was negative. IBD 50 got hammered down close to 3%. Small stocks, Woodward Brown float under 7 million. There was only one that made it to the list, and it was down considerably. What was winners? Best of Woodward and Brown, 5 to 4 winners over losers, up 4.5%. Best stocks under 15, up 3.3%. You can see some of the groups that were up. Overall, the market was down, and I was down. My buy watch was down 1.13%. So the market was down. You already know that. Now let's go into HGSI. Let's go into market analysis user groups. The old Woodward and Brown user group replacement, major markets plus. And let's go to the top-down view and take a look at the major market indexes. Oil, no surprise, led the way, up 5.3% with the OPEC changes on Friday. Sorry, my wife hates it when I do this. She just asked me if I'm almost done. Nope, halfway there. Let's take a look at some of my favorites. We'll start with the S&P 500. Now I'm going to go into a view here, and then I'm going to open up a second view. That second view, I'm going to put Chris Wilson's weekly indicators on just to give me a sense of what's going on in the weekly chart as well. Now, this trend line here, I drew back when I was looking at the apex of this triangle. And it's interesting that this trend line continues to hold, which is why I saw that other trend line, which I drew earlier for you. So all we've done is we've pulled back to a rising trend line. The weekly bongo is green. As I stated earlier, I'm more of a buyer than a seller here. I think the market's more bullish than people want to give it credit for, but I'm not stupid. I'm going to watch the indices. And yes, I agree with everybody else. Summertime can be bad and we're overdue a correction. The Dow Jones Industrial Average, um, clearly much weaker, but is it really? I mean, you could certainly say that we're going to pull back to the 24,450 range and bounce. It's closer to the 200-day moving average. It's below the 50 and the 17, but still in an uptrend even after this pullback. Its weekly bongo is red, so the Dow clearly is weaker. If I look at the NASDAQ composite, new highs hit on Thursday. Weekly bongos are green, which is my long-term buy-sell signal. Again, if I had to choose to be bullish or bearish, I'm bullish with a flag down to the 17-day simple moving average. But clearly, risk is higher in the market. Notice the volume on Friday. This is probably related to some revisions of the Russell indices that caused some major volume shifts in some of the stocks and may have led to aberrations for one day on something like Bluebird Bio as an example, which got hammered. Russell 2000, similar to the NASDAQ, again, a flag and a big pullback. Hard for me to be super bearish here, although the big picture, I get it. It is a much higher risky market. I'm not telling you to go out and blindly buy everything. I'm just telling you that it may be a little early to short everything. The dollar, as we talked about, has pulled back some over the last several days. As I mentioned on the weekly, the dollar is pulling back, and be interesting to see if it falls below that 200. Now, this looks different than the futures. This is a ETF. The futures, I believe, have already gotten down there. Let's take a quick look. Oh, I got to figure out where I'm looking at. Sorry about that, folks. You can see the dollar. You know what? I'm not going to do this right now. This is going to take a lot of time for me to match things up because I didn't do that. There we go. You can see the dollar has pulled back for now with a new PPS sell signal. Dollar weakening. The CBOE volatility index, as we talked about, struggling to get out of this choppy range. It's got some moving average cover overhead, which might make it difficult. If the dollar starts to weaken, maybe it's time to look at gold. Little bounce over the week. It's still, if anything, gold's still a mess, as is silver. Bounced on Friday, and the big winner on the week was oil. And here's USO, and you could see a big move. Both the daily and the weekly bongos went to green, a kahuna, and a big volume. So clearly not a market necessarily to be a hero in, but I'm not convinced that this market is going south very quickly. Industry groups. There's 174 groups that we look at. And if I go to the two-day force, I can see that as of Friday, I had 52 groups to the upside. If I look at a two-day down, I had 5 groups to the downside. So yes, there was pain. Specialty apparel stores, Foot Locker down 3.9%, American Eagle Outfitters down 3.5%, Taylor Brands down 3.3%, Chico's down 2.9%, Duluth Holdings, I wonder if their underwear is as good as they say on TV, down 3%. That's weak, very weak. Apparel footwear, Decker's down 2.3, Carter's down 2.7. So there is weakness Department stores carrying on the theme of retail, 4% on Macy's, Kohl's, 3% on Dillard's. So department stores were weak. And then payment processor, I know I had some Paycom, it was weak, but PayPal was down just a bit. So weakness perhaps in retail apparel and specialty apparel and footwear. But for the most part, 5 down and 52 up to me is overwhelmingly to the upside. Let's go a longer period of time. Let's look at 5 days. I've got 48 up, and 5 days to the downside, I have 39 down. So it's much more mixed on a longer time frame, neutral perhaps. But gosh, everybody thinks the market's done, and on a 2-day performance, the market is way outperforming. Now let's look at the top, and let's look at what's leading this market. Energy, number 1, number 2, number 4, number 8, number 13, and there's only marine shipping is energy as well. The only thing that's missing here is what? Refiners. And as I did my top and bottoms up review, refiners were the only weak place that I saw in energy. If I right click on exploration and production, let's take a look at some of these. Here's Anadarko Petroleum, and let's switch to this view on stocks. Here's a stock that's moved from 42 to 72, and it's still running at a Bible gap up on Friday. That's a pocket pivot. Down here is a kahuna. This is a mobile breakout from a squeeze. There's a Bible gap up. Everything here is green. Look at the earnings per share growth here. It's been strong for a while. Turnaround stock from losing to making money. Doesn't have a PE because these two negatives are going to drop out. These two positives are going to replace them. I think this looks great, pays a small dividend, and I like Anadarko Petroleum. Here's a smaller one, Whiting. You can see it's had big revenue growth. Earnings have been up and down, but they've been down for a while, turned positive in March. Big growth, you're going to drop out a minus $1.28 between the June and September quarters, and you're going to add a plus $1.26. What is that going to do to this stock? I think it's going to take it higher. 2 kahunas last week, a mobile breakout from a squeeze, breaking above recent highs. Whiting Petroleum looks strong to me. Marathon, trying as well to break out. Kahunas, mobile breakout from a squeeze. Great earnings per share growth. ConocoPhillips, I got shaken out a few days ago, or a week ago, 2 weeks ago, but I had a nice run here, buying it off of every time it would pull back. Well, it's sitting right on the 50 and had a kahuna, and it has great earnings per share growth and pays a small dividend. All of those stocks look good to me. Pioneer Natural Resources, a little tougher call as it's deeper in its pattern, which means it's less expensive on a multiple perspective. Pocket pivots and kahunas, but I'd rather buy stocks that are breaking to new highs or at least above their major averages, not things that are down like this. And there's the index, so let's go back up here. So right click back, services. These have been in the toilet because they've been sort of dependent upon oil prices, which are now starting to turn around, and on the number of drillers. Here's ESV, had a nice run, pulled back to the 50, and had a kahuna, a gap up from a squeeze, doesn't make money, pays a teeny-weeny dividend. The big guys are Schlumberger and Halliburton. They don't look great, but maybe these are stocks you want to buy when they're cheap. They got great earnings per share growth opportunities. I didn't see anything that I really loved on these. Every once in a while, somebody's getting excited by Rick. And, I look at the earnings per share growth. I don't get that excited, but it should also benefit from rising oil prices. And I usually go through, and I'll go through a couple more of these groups, the top 10, cable and satellite. There's madness now about who's buying who. Ever since the government showed that they're willing to allow a vertical merger. Comcast, kahuna, pocket pivots, mobile breakout, green up here, decent earnings per share growth, greater than its multiple, 2.2% dividend, potentially a acquirer of assets. There's going to be some bidding wars. I don't know how to play this. Charter, this is one that was a great short back in February, became a viable opportunity recently. It continues to trudge back. It's an expensive stock. It looks to me like it's going higher. Just not a fan. 1 second. Just want to make sure I'm looking at them in the right order. I guess I am. Liberty Global, again, I don't know this group. It's breaking above the 50, but it's in a downtrend, so I don't like it. Now we're in the index, and that's as far as I'm going to look. Continuing to look down, integrated oils. These are neat because they have multiple components. They have refining, they have exploration, they have MLPs, they produce a dividend. Here's Exxon. You want to buy it off of major moving averages, coming in off the 200. Great earnings per share growth, trades at a multiple 22, pays a 4% dividend. Royal Dutch Shell, Kahuna's, pocket pivots, mobile breakout from a squeeze on Friday. Don't know what to make of this quarter, but the next quarter looks strong. 4.6% dividend. Chevron sitting on the 50 with a Kahuna, 3.6% dividend, operate earnings per share growth. BP, 5.2% dividend, breaking up. Perhaps I like this one the most with that move it had on Friday and that 5.2% dividend. You need to be in energy. REITs, these sort of confuse me as to why these things are moving up, especially in the setting of allegedly rising interest rates. This is a pattern that I love. This is Core Civic, CXW. And as you can see, it's a turnaround stock where its earnings, which have been tracking negative, turn positive the next 2 quarters. You can see a dividend yield of 7.3%. It trades at a multiple much lower than its growth rate. And it broke above the 200. Lots of pocket pivots. Now, I'd want to make sure that this company wasn't being bought when I see this pattern, so I'd go more info from the web, and it will go right to this group. And nope, they're just up because it says they're going to benefit from the border policy. Now, this is a stock that's been in a downtrend for a long time. On the weekly, you can see back here, it reversed in late March. It broke above the 200. You can put your stop below that 200. You're not risking much. This looks to me like a stock that's going higher and is on my buy watch list. I'm going to come back to this pattern in a second. Simon Property, I have a hard time buying retail. Tangier, I kind of like the pattern though. Big volume must be related to moving around the indexes, good industry strength, lots of pocket pivots. This is one that I'm going to look at my buy list, 5.9%. Look at the growth here. And then another place that I've been in and out of the market has been Public Storage. I use one, much to my wife's chagrin, $200 a month. And I never even go there, and I store my baseball cards, which I'll never do anything with. It's dumb. But I'm not the only one because they're packed. 3.5% dividend. Now I want to go back to that CXW. I sat at a meeting, and I'm sure there's people who'll be watching this that were at this meeting with George Lee in Orange County in, I think, early April. And this is not quite a Jesse Signs stock, as it's really not gone sideways long enough. But I introduced folks to a company that I was starting to build a big position in. And that company was Tandem. In Tandem at the time, let's go back to that meeting. You've already seen where it went. It was one of these fallen angels that had came back, and I think that's about when we were see this date. This looks familiar. Yep, that was the day after the meeting. So based upon This was Thursday. That was Friday. All right. I brought this stock up and introduced it and talked about Jesse Stein, talking about stocks that have been in long-term downtrends or going sideways and something changes. I talked about the volume increasing in the stock, which is something that made me pay attention to it. I looked at the weekly and you could see it right here is a signal that I'd like to figure out how to duplicate it with math and put it into TradeStation. But when I have my weekly charts, this is from Chris Wilson years ago, when the relative strength of the index crosses above the relative strength of the S&P 500, or in this case, the relative strength of the stock tandem, okay, and this was on 223, and I had a kahuna, and my weekly bongo has now turned green. That is a super strong buy signal as it moves above these moving averages. I waited. This was the next move here when it crossed above the second of the moving averages. That's how I found the stock, and I bought it. And I bought a big position because these are easy because your stops don't have to be that far away. And lo and behold, the stock went up to 24, and I took some profits on Friday. I like to see moves like that. Who wouldn't want to see a move from $5 or $6 to 24 in 4 months? Makes up for a sideways market in many different ways. So typically I'll continue now looking at, we go back to this one, the various industry groups. And I usually go through 10. Only a couple comments about biotech. Tesaro is one that I know extremely well, has sold off because of some disappointments. One drug had a new black box warning. The other drug turned out to not be as outstanding compared to its competitors as was initially thought. And it's gone from a 16 billion, 15 billion market cap. Now it's down to 2.7 billion. This one is ripe for the taking. They might have to pay up to that 200-day moving average price to get it. But this is a stock that was a darling back here when everybody was looking at buying the stock when it was $190. So I am not in it today, and I'm not sure I can go in it because we do work with them, and I have agreements that say I can't buy them. I don't know any inside information that I'm telling you about, but I'm seeing a stock that's bouncing here, two kahunas. I think something's going on, and this is the kind of stock that looks to me like it's somebody's acquiring them. And look, I had a kahuna weekly bongo, took out a moving average, and all I got to do is get my relative strength above the S&P 500. So I like Tesaro. Don't know anything about Rhythm. This one was on my watch list. It's a little bit extended. Look at the high jumps all the way up here. Don't know anything about it. It's got huge earnings coming in when they report. I don't know if they've reported. I'm not sure if they've reported already. Don't know anything about them. It's a beautiful chart, but it's too far gone for me. Vertex, this one looks like it's at an interesting buy point. It makes a lot of money. It's growing its revenue, at least over it was a year ago, 2 years ago, and trades at a high multiple but a high growth rate. That one looks interesting just because it's sitting on its moving averages and had a pocket pivot. This one. I'm a little nervous about biotech, to be honest, because concern about Trump and drug pricing. And I think there is going to be something, but one way to play biotech that I've talked about many times is just to play the ETFs. Buy them when they're up and sell them when they're dropping. This is a pretty volatile instrument. I play the LABU long and short because I'd rather play a $100 instrument than the LABD, which is a much cheaper instrument down here. All right. I'm getting tired. My wife's getting tired of me talking. Let's go into my buy list for the week and see if I have anything else to tell you. After I do my bottoms up and my top down analysis, I end up with a list of stocks that I'm interested in potentially taking positions in, or at least watching them. My buy list for this week is over here. And the first thing I want to do is go over here to industry groups and show you that, hold on a second, there's a lot of exploration and production companies in my list. A lot. So I showed you some of the best in Anadarko. Energen, another one that looks good. I can't remember if I showed this one to you or not. Let me just pull it up real quick. Yep, sitting on its 50. Well, we'll break out from a squeeze. Bongo's green, Pocket Pivot, Kahuna. Great earnings per share growth. So if you don't have any energy production stocks, you're missing out. I am going to watch oil futures and make sure that the initial enthusiasm continues. The one biotech that made my list, Regeneron, the reason it made my list is sort of that bottom fishing. The stock's definitely starting to move. Notice what we had on Friday. We had a Kahuna, a new weekly bongo, taking out the moving averages, and the relative strength of Regeneron crossing over the S&P 500. Look, with volume coming in. So I find Regeneron to be interesting in the biotech space. What a strong stock United Healthcare has been this year. And as I looked at it, I thought, here it is pulling back, pocket pivot. I'm not buying it here, but if it takes out this PSAR dot, especially if I get a Kahuna, I might want to chase a little bit. It's given me a buying opportunity by pulling back. So that's United Health. Steel, I put in Reliance Steel here. It's not necessarily ready yet. I already own U.S. Steel. That would be another option. Here's some more energy on the services side, or on the, Cheniere and MRC Global. New Park, look at this chart. Bible gap up off the 50 with the Kahuna. Everything's green, out of the squeeze. Great earnings per share growth coming in. A bunch of REITs. I showed you Corrective. I showed you Tangier. Another one I liked was VTR, Ventus. Now, it has to get above the 200 for me to get interesting, but I do look at other things, including my indicators with John Person's stuff. And if I remember correctly, this is one that was interesting here. And you can see a high close doji on a trend line with a new daily buy, OBV going up, coming out of a squeeze. This one has a lot I like. I believe this one may be end of life hospice, if I remember correctly. Long-term skilled nursing homes, senior living, areas that are of interest. And I showed you the Corrections Institute. So these are the stocks that I'm looking at. Obviously, that's not a big list. It's certainly not all encompassing. And how the market behaves on Monday or tonight when futures come out will matter to me. What I do is I'll be watching certain things. They're not open yet, but I'll be looking at the futures markets. And I'll be getting up because I got to catch a plane at 5 o'clock, 5:30 in the morning here, which is 11:30 your time. So I'll see the futures then. I'm interested in what the dollar does. I'm very interested in oil, especially if I want to open up some more positions here. After a 5.7% move on Friday, maybe I should expect a pullback to begin the week. I look at the various industry groups. That's not what I wanted. How about this one? Green means there's positive momentum, red means there's negative momentum. And what I notice is that discretionary, healthcare, energy, real estate, utilities, and staples look good. The S&P, financials, technology, materials, although it had a good day on Friday, and industrials look weak. So I'm going to watch the various sector groups. I think we got another run up. I just, I'm probably too much of a bull. I am cautious. And let me just finish with something from Edge Raider that tickled me a bit. I tried to look for if there's any strong signals of seasonality. I mean, Sally Beauty Holdings, if we look at the next 2 weeks, is 11 years up out of 11 years, but it's only a 4% move. From a 1 month perspective, India earnings wisdom tree has been up 10 out of 10 years at this time with a 5% return. Nothing major up here. Emerging markets bull up 8 out of 9 years, average return 14%. Here's what got me interested. VIX, 9 years in a row down, average drop in the next 4 weeks is 16%. To me, that's a big drop. Maybe I'm crazy, but that's pretty negative. Financial bears, last 9 years over the next month have dropped 9% on average. S&P 500 bears has been down 8 out of 9 years. Average drop, 10%. The ultra short Qs have been down 9 out of 11 years. Average drop, 7%. So some of the contra ETFs, the Dow, S&P 500, 9 out of 11 years, down average of 5%, same as the Dow. So if all the things that go up when the market goes down are falling, and that's been consistent for a decade, maybe it tells me we got that run up here. So last thing I'm going to look at is my timing chart, which those that have been to my live meetings or some of my live webinars participated in. This is something that I use to decide whether I'm in and out of the market. And let me get the S&P 500 up. And then I'm going to say to my wife's happiness, good night. We are well above my multiple moving averages. We've got a weekly bond goes green. The signal line crossed over the moving average on the MACD. The histogram has turned positive. I'm still in the green box. I'm still long. So on that note, I'm going to say good night. I'm not stupid. I'm not going to ignore the market. If the market futures tell me to get out, I'll get out. But I think that we may have another leg up before this is done. You all have a great week, and I'll probably do this again 4th of July weekend, maybe the weekend after. I'm going to do this intermittently as my schedule allows. Tonight was a packing day, so I thought I'd get it done. Have a great week, everybody, and I'll see you on the other side. Thanks.